Okay, so the loan calculators webinar, this is what we will cover. I'm going to give you a basic overview of the calculators in Mercury. There are some different types of calculators. We have our quick calculators, also known as our widgets. They're just some quick and easy calculators. You've probably seen them on a million lender sites and what have you. But the beauty of our particular widgets is if you would like some calculators on your particular website, we can actually arrange it so they can display for you. When we go to the widgets, I will explain a little bit further. Then we have our three main calculators: funding position, loan comparison, and borrowing capacity. These are the three calculators that you will generally use to actually inform a decision on a product and a lender for a client. So you'll run a series of these calculators to find out the best product for your client and how much your client needs to borrow and so on. We'll show you how to link the calculators into a CRM record, so into an opportunity, and I'll also show you how to print off a report on the calculators and save them into Mercury and so on. So here we are in Mercury, and where we're going to be concentrating today is this calculators tab. But before we jump into there, I just want to show you these three buttons here on the dashboard. So on the dashboard you can see there's start a funding position, start a borrowing capacity, and start a product comparison, so you can see how easy to start one from here. But where we will begin today is actually in the widgets, so I'm going to jump down here to the widgets and we'll have a quick look at these. So as I said, pretty straightforward types of calculators. You've probably seen a million of them before. There are 6 in total. The first one is a loan repayments widget. Pretty simple. Put in the figure, you can move the loan term along, you can change the actual interest rate, monthly, weekly, fortnightly payments, interest only. It'll give you your repayment, so the repayment on $450,000 is just over $2,900 a month. Total repayments and total interest that you would be paying. Shows your graph over here that you can mouse over, and as you can see it'll give you each year and how much is actually remaining on the principal. If you want to paste this graph into a report or into a document, you can do so by clicking that button, opening up your document, right-clicking and pasting. That's a fairly straightforward loan repayments calculator. Next one, the extra repayments, is more or less the same, but it has this extra field in here, additional repayment. So again, we'll take our $450,000 scenario, interest rate of 6.81, and let's put an extra monthly repayment. So I'm just going to put the frequency as this. Additional monthly repayment of, let's say, $500. So your client said they're happy to pay $3,500 a month. Let's put in $500 and you can see how it's calculated. There's our standard without extra repayment, and there's our extra repayment graph. So you can see the repayments, total interest, and how much they'll actually save by making those additional repayments. Property fees next. This will calculate the fees to be paid on a transaction on a state-by-state basis. So it will change. If you can see here, this is Victoria, and if we change to New South Wales, you'll see it's put in an extra couple of fields here because there are different types of concessions in New South Wales. Go back to Victoria. Let's put our purchase price of, let's say, $550 and loan amount of $450. It's a house, it's a purchase, owner-occupied. I'll check that for a second. You can see there, just under $25,000 in stamp duty, but if we check the first home buyer, you can see it's dropped down to just under 20, so you can see how it's applied the first home buyer concession to that, and then the total down the bottom. Product comparison next. This just allows us to do a really quick side-by-side comparison of two products. So we've got some things in mind. We know some products off the off the top of our heads, and what we want to do very quickly is do a bit of a comparison here. So loan one, let's say loan one has an upfront fee of $650. It's got no ongoing fees, but let's say it has a honeymoon period, fixed rate period of 6.55% for 1 year, and then it reverts to, let's say, 7.25%. So it's got a honeymoon period and then reverts to a variable 7.25%. Fixed repayment is just $28,500, sorry, $2,850. Ongoing repayment, total fees over the life of the loan, total interest, total cost. Loan 2, let's say it has no upfront, but maybe it's got an annual fee of $350. No fixed rate, but it's got a variable rate of, let's say, 6.81%. As you can see, ongoing repayments, $2,936. Total fees is $10,500 over the life of the loan. Total interest, total cost, and you can see down here, loan 2 is actually cheaper by about $35,000. So it's an easy way to just plug in some scenarios and get a little bit of a comparison here. Borrowing capacity is next. Pretty simple. We can select 1 or 2 applicants, so let's just put in 2 for the heck of it. How many dependents? Let's put in 2 dependents as well. Annual gross salary of person 1 is $75,000. Person 2 can be $85,000. Do they get any rental income? No. Are there any other rental annual incomes? Maybe bonuses, shares, so on and so forth. Let's say no in this case, just to keep it simple. Monthly credit card repayment. Let's say person 1 has got a credit card, pays $75. Person 2 doesn't. Credit card limit can be $2,500. Any car repayment. Let's say person 2 has a car repayment of $250 per month. And any other expenses, they might have a regular sporting expenses or educational expenses or some other type of expense that is a regular that you'd want to take into account. I'll just say no in this particular case. Click on calculate, and there are our lenders over there. You can see the top 5 lenders and the figures here of the maximum they may be willing to borrow or lend rather. So nice, quick, simple borrowing capacity calculator. Please note these figures, this calculator will take into account each lender's monthly living expenses. So we've got all that data in the background, and that's actually taken into account in this particular calculation. So you don't need to put in the monthly expenses, the standard monthly expenses, living expenses down here. I've had a question about the QBE one up here. I'm not entirely sure what that represents. I'm not really over each individual lender and what exactly they do and they don't. So yeah, I can't tell you why the QBE one is popping up there. And the last thing, income tax calculator, really simple way to get a calculation for income tax. So your client might have told you what they earn every year, but they can't tell you what that breaks down to after tax. Very simple, plug in their gross income, and you can see here it gives you annually, quarter, monthly, fortnightly, weekly, gross income tax and net income. Please note, this is straight up and down income tax. Does not take into account the likes of Medicare levy surcharges, any family tax benefits that you might receive, no HECS, no student financial supplement loans, nothing like that, straight up and down income tax. And they are the widget calculators. As I said, it is possible to have these on your website if you wanted them. You can customize the colors. That's all explained if you do decide you want them. Put a ticket through the help desk saying you're interested in the calculators and having them on your website. Please note, at this point in time, it won't cost you anything. We do envisage at some stage in the future there will be probably a $50 per month charge to have those hosted. At the moment there are no plans to actually implement that cost, but it will likely be implemented one day. If that is the case, we will let you know beforehand, and we will give you the option of opting out essentially if you decide you don't want to pay it. But just bear that in mind when you do set up your website. One day in the future they may be charged at $50 per month. So they're the widgets. What we'll do now, we'll jump up into the main calculators up here, and we'll actually work through each calculation. So we'll start off with a funding position calculator. Funding position calculator is going to tell us essentially what a client needs in order to finance a particular scenario. So click on the new funding position. That button will change. You can see there it's changed to product comparison, but we'll go back to funding position. Click the new button, and it's going to open up a new funding position ready to go. Now, had I have opened this from an opportunity, so there is a calculators tab and an opportunity, which I'll show you later on. Had I have opened it from an opportunity, and in that opportunity I had put some security assets into the assets and liabilities, it would have pre-filled them for me. So we do get rid of as much duplication as possible. If I had have opened it from an opportunity, in that opportunity under the assets and liabilities there were some security properties, they would have imported into here automatically for me. But we've just opened it from the calculators section, so that won't happen. Now what I'm going to do in this situation, I'm going to make this a refinance, so I'll make it something a little bit interesting, not just a straight up and down purchase. So what I need to do is add a second property in. Now I do that with the new property button. There we go. So here's property 1, here's property 2. Property 1 can be the existing property that we're refinancing against. I'm just going to call that existing. And property 2 is the new investment property. So existing property, what is the purpose? This one is owner occupied. What is the transaction? It is a refinance. Where is it located? Victoria. What is it? It's a house. Fantastic. No duty concession. It is the primary residence, so I'll leave that checked. What is the value of the existing property? Let's say this one is $600,000. No, let's make a bit less than that. We'll make it $500,000. It is a existing dwelling, so we don't put any construction costs. However, if you are putting in a property yet to be constructed, make sure you do split it, value of the land and then value of the construction costs. That will affect the stamp duty calculation in most states, if not all states. So it's $500,000 property. There's no stamp duty, obviously, because we're not purchasing anything. Scrolling down, looking down. Current loan balance, let's say they currently own $300,000 on this particular property. And we'll say, we'll roll, no, it is refinance, so we'll leave it as that. And then the second property we need to fill in, so investment, it is purpose for investment. It is a purchase, it's in Victoria, and we'll say it's a house. It is not the primary residence, so we'll leave that unticked. Value, let's say it's $400,000. We won't say there's any construction costs, so this again is an existing dwelling. Now down here you can see it's calculated some fees for us automatically. Now there's likely only to be one set of registration fees if we're going to refinance against this and actually roll this this loan balance into the new one. So get rid of that and hopefully it won't spring back up. No, it won't. So some lender setup fees. Let's put aside $500 for the setup fees. Client legal fees, let's set aside $2,000. Are there any discharge costs? So that would happen if they were, let's say they were going to a new lender, there might be some discharge costs. Let's just say for this situation there won't be because they're refinancing with the same lender. And are there any other costs which aren't covered here? There is a field here for it as well. So there we have it. You can see total costs just under $23,000. And where we're currently sitting, over here you can see we need about $723,000. And what that will do, that will cover both properties. That will cover the $300,000 outstanding on this one and also cover the cost of the purchase plus the fees on this one. So over here, under loan requested, let's put in $723,000. There we go. So there's our situation. We've got some other things that we need to put in, some funds and some debts that we want to repay. Let's say our client has some savings. So let's say own savings. They have $50,000. And another fund, they also have, let's say another, and maybe it's $25,000. And some debts. They want to get rid of their credit card and they want to get rid of their car loan. Oops. They're only little ones. Credit card's only $2,000 and the car loan, let's say, is $5,500. So only little debts that they're going to clear out. But there we go. Now we're $67,000 over, so we need to drop this down a little bit. Should have put the additional funds in first. So that's the figure we now need to borrow, $655,000, let's say $657, just to build in a little bit of margin of error. There we go. So we're $1,600 in the clear. You can see we have an overall LVR of 73%. The new loan, or the total loan, is going to be $657 versus $900,000 security. Now we don't need LMI in this particular case, but I tell you what, let's make it so we do. So I'm just going to rejig this around a little bit just so we do need some LMI. There we go. So we're over the 80% threshold. We now need LMI, and what we do to get that is just click on this Get LMI Quote. Now this will do a search for all LMI in our particular state. And what you'll see, there's a whole range of different ones, but they're generally more or less the same. So we end there. So you can see the worst is, say, 7,000. The best is with ING, with the reduced equity, is just on 4.5. Let's say 5.5. So 5.5 to $7,000. So it's not a huge range. And what you'll see is they're generally all around, say, $5,600 to $5,900. So we'll take one somewhere in the middle, click on choose, and it puts it in there, and we can be fairly certain that that's going to cover just about any LMI that they're going to need to take out. Our summary position is quite good, so we do have more than we sort of need set aside. There we go. So we've built in a little margin of error anyway. There we go. So there's our situation. I'm going to click on Capitalise to roll that LMI into the actual loan amount, and our final loan amount is $732,874. Let's say $733. So we're $733 short of where we need to be. With that figure, what we can now do is we can move on to the other steps in our situation, in our scenario. But that's a funding position calculator. Bit of a tip, name it as well. Always a good idea to name your calculations. Makes it much easier to find later on down the track. That'll do. Codio refinance. Save and exit. Click on save and you'll see it pop up. There it is there. So there's our calculation. So we need $733,000. What I'm going to do next is I might just do a borrowing capacity, just something different. The actual order in which you do these calculations is up to you. So there is no set order. I'm going to do a borrowing capacity next. Click on new capacity, open up a new one, and we can start putting in some data. Once again, if you generate this from an opportunity, what it will do is it will pre-fill all incomes and expenses which have been put into all applicants on that particular record. I will show you this in a little while, so later on when I show you how you can actually link these into the CRM, I will show you exactly where. But again, it will remove any duplication if you have already entered in the data. Let's rename it, so Codio Refinance. So it's the same as the funding position calculator. Let's put in some dependents. I'm going to put in one, and I'm going to put a second person as well. Click on the new person. So here we have our people. Person one, let's say person one has a salary of $95,000, no rental, no family allowance. Let's say they get a bonus every month, on average $750. Expenses, they have a credit card at the moment. It's $75 per month they pay, and the limit is $2,500. And they have a car loan, and I believe it was $250. It is important to put these in, even if they're going to be cleared. They will affect the servicing. Person two has an annual salary of $100,000 per year. One more. Let's say they have some dividends from shares annually. Say it's $4,500. And that's it. And we'll say they have a store card. I thought there was a store card here somewhere. Other, monthly, and the amount is I don't know, $50 per month. Actually, that's not going to work very well. Let's put it in as a credit card. And the store card has a $1,500 limit. There we go. So there's our situation. We click on calculate, and you can see now we get just about a complete list of all our lenders on our panel and how much they might be willing to lend. Now, a couple of things to keep in mind here. This is not an exhaustive list. It is not every single lender on our panel. The reason being, not every single lender on our panel has provided us with satisfactory data to actually include into this calculation. What you will find with our borrowing capacity calculation is, more often than not, they are within maybe $200 to $300 of the actual lender servicing calculator. They are extremely accurate. We will not put or include a lender in here unless we are confident we can get their calculation to be very, very accurate. That's why you might not see every single lender in here, but you'll see the list is pretty great. The maximum amount is the maximum amount they may be willing to lend. It is not be all and end all. It is not the final say. At the end of the day, the lender will still say whether or not, yes, they are willing to lend a certain amount of money. So you wouldn't use this as something to maybe support an argument. You do use this as a guide. we need to borrow 730. Our calculator is saying up to 1.3 and as low as 1 million. Where that's really comfortable, you would be very confident that, assuming you've got all the figures correct, they are comfortably going to be able to service a loan through any of the lenders. If they needed to borrow $1.1 million, and you can see here a lot of the lenders in the middle, especially all the Genworth ones, are only $50,000 above that, that is where you would want to be very careful, and you would want to make sure you are going to the lender, getting their servicing calculator and putting the figures through a couple of their servicing calculators as well. So just bear that in mind. And you'll also see here in the comments, there are some comments next to some of the lenders that give a little bit of a note on each particular amount. You can see their LVR differences. So Homesite have two figures, one based on below 80, one based on above 80. So just a few things to bear in mind there where you are using this. As I said, they are extremely accurate, but at the end of the day, you do need to make sure that you are checking with the lender that you finally decide on to make sure that they can service the loan. Now, the calculator will do negative gearing, and I'll very quickly run through how to do negative gearing. It's a little bit, not complex, but it can be a touch confusing, so try and bear with me here. First, we need to check the negative gearing box, and what you'll see is we now get a tax benefit field for each person. If I had 3 people, there would be 3 of these. You need to assign a tax benefit. I'm just going to say 50-50. But then what we need to do is we need to come down here into each person's record, and we now need to tell the calculation how much each month our clients are gaining from rental income, how much they are paying in the form of a mortgage on that rental income, and how much of that repayment is interest. Let's begin by putting in the income. I'm going to put in income, I'm going to put in a rental, and I'm going to say, I'll just use annual figures because they're easier, and let's say $25,000 per year. You now need to put in one expense if it's interest only. We now need to put in a investment loan repayment, which is this one here, and let's say they're repaying $27,000 per year. Now, if that is all interest, so it is an interest-only loan, we just leave it as that. If not, what we need to do is we need to create a second expense, and we need to tell the calculation how much of that repayment is interest, and do that by putting in an existing interest. And I'm going to say, let's pretend that is actually interest and principal, and of that, $21,000 per year is interest. So there we go. So what I've just done there is I've put in the rental income, I put in the total repayments, and I've told the calculation that of the total repayments, $21,000 is interest. So this isn't adding a $21,000 expense to the calculation, it's telling the calculation that of this $27,000, $21,000 is interest. And we need to put that in for both people. So rental, very quickly, $25,000 annually. There we go. So we've split it 50-50, click on calculate, and I've obviously made a mistake there somewhere. Why hasn't that worked for me? Bear with me 1 second. Now, for some reason, it appears it's not picking up the investment loan, so it should work, but we'll pretend it does for now, and I'll have to get the developers to look into that once I finish the webinar. But setting it up like that will generally work. I'll get our developer to have a look at this as soon as I finish, and hopefully should be able to find what is happening there. It appears that the calculation isn't picking up that I put in the investment loan field, unless I've done something wrong. But anyway, that's how we do a negative gearing loan. And again, we would have figures over here if it was picking up this particular field, but it's not at the moment. And you can see, again, very limited amount of lenders over here. Once again, they're the only ones who have provided us with a decent amount of information to actually do negative gearing calculations. So save and exit, and that one's done. Final thing to do is a product comparison. So now what we can do a side-by-side comparison of two or more products to find which one's the best. We know our client needs to borrow $733,000. We know our client can comfortably service that amount because we did a borrowing capacity. Now let's do a product comparison. Click on the new button. It will open up the calculation, and the first thing you'll see is a product search. Why? Because we need to put a product into it first. So your client's given you a bit of an indication of the types of products they're interested in. Let's say they want something 3-year fixed, standard variable, pro pack, and they want offset, redraw, and interest only. Loan amount, $700, I think it was $33,000. So I put in some figures there. I now hit run search. It's going to pull up a list of products which match our scenario here. How it will order these is first by rate 1, then by rate 2, then by number of features. So you can see here, it starts at the cheapest rate on rate 1, sorts through that way. If we get two that are the same, like those two there, and that's it'll go to rate, no, then I think it will go to setup costs and then to rate 2. So it's actually made a fibber of me there. Anyway, so we'll scroll back up to the top. Let's look for some good products. This one looks good. Now it only has one of 3 features, so it only has one of these 3 features here. Our clients have said bare minimum 2 of these, so if it only has one, not interested. So we're going to leave out Commonwealth. Let's look at the St. George product. And scrolling down, let's look at the home side with above 75 up to 90% LVR. It's got at least two features. I like that one. And one more. Let's get the, what else have we got here? Let's get the Macquarie Optimum Package line of credit fixed. No, let's go the premium fixed instead, this one. Click on that one. Click on Use Products, and it's going to pull them into our side-by-side comparison. So I've only got 3 here. You can put plenty more in. You can put dozens in if you really like, but realistically, I try and keep it to about half a dozen products. Generally, you're going to get the best one out of half a dozen that you come up with anyway. So it's pulled in our products. Once again, don't forget to name it. A refinance. There's the amount. There's our loan term. We just want default repayment, so we'll leave it as 0. We won't put in an extra repayment just yet. Okay, there we go. So I've just changed the frequency just to rejig it, and what it's now done is it's now calculated, and it's putting in the cheapest through to the least cheapest loan left to right. So you can see it's ordering by loan cost, and it does that left to right. If we have a look down here, we have the principal amount, we have our 2 rates, so they're our 3-year fixed and then our 27-year variable. The repayments on each period, the frequency of the repayments on this particular product. Are we having an extra repayment? Interest only boxes. Now we can click this one to click all of them, or we can just check one of these boxes if we want one particular product as interest only. I'll make this interest only. Setup fees, monthly, annual fees, total interest to be paid, total fees to be paid, the loan term as it currently stands, the end balance of the loan, this is interest only, so obviously we're not paying off the principal, default total cost, total loan cost, and the savings relative to default. So what that means, this default total cost will never change. This will always be that particular figure. It leaves it constant, so we can see when we add in offsets, when we add in extra repayments, we can see what it's actually done to each calculation against the default total cost. So that will stay just as a straight 30-year standard repayment, no offset. And then total loan cost will start calculating in the differences. So what this has done, it's actually cost us $500,000 essentially to go interest only, because we'll have paid all of that interest off by the end of the period without actually making a dent in the principal. So every repayment is pure interest. And finally, we have our comparative saving field, which is saving versus the most expensive product. So the St. George product is the most expensive. There's 0 saving. you can see the home side product is $175,000 cheaper than the St. George product, again, over the life of the loan. So that's 30 years. What we can now do is we can start putting in some extra repayments and some other bits and pieces, some extra lump sums and some offsets. Let's just say your client has said, on average, they're happy to pay, let's say, $4,500 per month. If we have a look at this, we've got 42, we've got 39. Let's say we're going to add $300 a month to this repayment. We're going to add about the same to this one, and we can add $200 to this one. And that takes some sort of average repayment to about $500 extra every month. And I'm going to get rid of the interest only as well on that one, just so this makes sense. There we go. So I've just gotten rid of the interest only because obviously it doesn't make much sense to make extra payments if you're not paying off the principal. So as you can see, our figures have now changed. Total interest being paid is $800. You can see that the default total cost is still that $1.03 million. Total loan cost has dived because we've gotten rid of the interest only. Savings relative to default is $196. So that $300 a month is saving us nearly $200,000 a month off the life of the loan. And again, we have our comparative saving with the St. George. What you can also see is our loan term is now only 25 years. So that $300 per month will actually shave 5 years off the length of the loan, as well as $200,000 off the actual cost. Let's put in an offset balance. So our client said they have an account that they like to keep some rainy day money in. They intend on leaving it there, but they're going to put it into an offset. Let's say it's got $25,000 average. So we put $25,000 in there. Click on another field so it will recalculate. Now nothing's changed there. What that means is none of them have offset on their in their features. So they're obviously interest only and redraw. What we would see if there was a product here with offset, it would obviously recalculate, our savings would go up, and it may even become the better product. And next thing, let's add a lump sum redraw and a lump sum repayment as well. So again, client has a term deposit. It's due to mature in, let's say, only 3 years' time. It's been in for a couple of years. Let's add it in. So in 3 years' time, in 36 months' time, they're going to have another $25,000 to pay off their mortgage. They intend on putting it all onto their mortgage. So in 36 months, you can see our savings have now jumped again. Our loan cost has dropped by about $90,000. Savings gone up. Comparative savings about the same. What they've also said is they intend on having kids in a few years' time, and just before they do that, they wish to redraw off their mortgage to do a little extension on their house to get it child ready. So let's add in a redraw. We hit the green plus. Let's say it's in 8 years' time. They intend on, 7 years. They want to start making some modifications. 60 months, and let's say $50,000 they intend on redrawing. That's only 5 years. Let's make that 84 months, 7 years' time. So there we go. We've put in our, and we better put a minus on that one. So I've put in a redraw there as well of $50,000, and you can see cost has gone back up, $840, saving relative to default $160. So there's our calculation. The home side here has come out in front, and from this calculation, that is likely the one we would go with. Now, a couple of things that we can also do here. You may either get some sort of bonus interest rate because you're a gold-plated broker, or whatever the situation might be with a particular lender. You can actually change each product to reflect different circumstances if you know them to be different. Let's say home side, actually let's say Macquarie, you get an extra 0.1% off the variable rate because you're a special broker. You can actually click on the heading of the product. So just to show that again, click on the heading of the product. It opens up the rate card. And what we can do here is we can actually apply a discount or change the rate. Let's make it a 0.05% on any standard variable. So you can see I've just put in an extra 0.05% discount. There we go. And if I click OK, once that recalculates, so it's doing a full recalculation, as you can see, the Macquarie one has now actually become the better bet. So thanks to our bonus that we get through Macquarie, this is now the product that is going to be best for our client. And again, you can also change fees if you know that perhaps lender has a bonus or a special on fees at the moment. You know they're waiving their annual fee or something like that for the time being. You can also change that field on anyone that's relevant. So there we go. Macquarie is the one to go with based on this. There are a couple of graphs that we can look at. The principal graph. Now you can see there are 4 lines. 4 or 3. Should be 4. 3 lines. There's our Macquarie product. Now again, just trying to figure out why that hasn't put in the repayment. So bear with me 1 second. For some reason the Macquarie product doesn't appear to be taking into account the lump sum repayment and redraw, so I'm just getting it to recalculate to see if that will come up. Bear with me 1 second, guys. Okay, so that's recalculated now appropriately. There we go. So there's our graph. That's better. And actually, it would appear the home side is still the better product, only barely. So there's our redraw. There's our lump sum repayment. There's our redraw, and you can see how that's affected the actual loan. And finally, compare costs. This will give us a rundown of the costs of each loan. Red is the principal, pink is the interest, and this little orange bar up the top are fees over the life of the loan. So you can see there's quite a huge difference between the St George and then the home side and the Macquarie products. And there we have it. That's our product comparison. So we've now figured out what our client needs to borrow, about $733,000. They can comfortably service that. We found that out with the borrowing capacity calculator. And we've now found that the home side product is going to be the best one for them out of the ones that we've identified. So a couple of things before we finish off. We can print out a report on each of the different calculators. They're all done exactly the same way. So I'll show you here while we're in the product comparison. The other ones, click the same button and you'll get a report for them as well. Merge document button right here, very straightforward. Simply click that button, give it a moment or two, and it will open up a report. And in this particular case, it'll give us a nice rundown on all of our products. So there it is there. There's a preliminary view of it, so we can see there, home side Macquarie St George. And what we can do, we can now click Edit with Word, Save As or Email. Let's save that as a PDF. And we'll just save it to our desktop. We'll just call it Product Comparison. Click on Save, click on OK. And now if I go over to my desktop, and I'll open it up, and you'll see here we now have a nice PDF. There it is, of our 3 products with all of the details, all of the figures. And if I scroll down, we'll see there's the second page of figures, and then we can also see our graphs. There's that line graph, and there's the fees graph. So you can see how we've got a full report there. As I said, the other 2 calculators both have that merge document button as well, and it's as simple as clicking that button to generate the report. Now the final thing before we finish up, I'm just going to jump into an opportunity now and actually show you where the calculators link into an opportunity. So I'm just going to open up this one here because it's the first one on my list, and there it is there. So this is an opportunity record, and you can see here under calculations, if I click on that, there are already 3 attached to this one. I'm going to quickly get rid of those 3 just to hopefully not confuse the situation. So there are our 3 there. If I save this one, no I haven't. So I just made sure I saved that one. Now what I can do is I can actually attach one to here. Click on the attach, click funding position. Let's look up Cody A, and there it is there. There's the one that I just completed. Click on choose, and you can see it's pulled it in. Mark it as active, so that's the one that any of our documents that pull data from Mercury will use. Alternatively, what we can do, and I explained this a little bit earlier, where the calculation will pull in any details of anything that's linked to it, security properties, incomes and expenses and the like. I'm going to do a borrowing capacity, and if we have a look at our contacts, you can see there's Andrew, Cody and Samantha Brown. Now I know Samantha Brown doesn't have any income and expenses information, but I know Andrew Cody does. So if you watch the calculation, when I click New Borrowing Capacity, what you'll see is it will actually fill Andrew in for us. There it is there, and you can see how it's done that. It's put in his salary, his bonus, his credit card, and his other expenses. So it's actually pulled all of those details in. There's no need for us to put them in again. As I said, Samantha doesn't have any details in her incomes and expenses. That's why it's just put in the standard form here. So you can see how it's removed some of the duplication for us because we've opened it straight from the actual opportunity rather than from the calculators tab. And there we have it. That's how you import them in or create them from an opportunity. And that is essentially the Loan Calculators webinar.